My name is Mike Rotting. Tonight's webinar is going to be technical analysis. It's part 1 of 2 that I'm presenting for Legacy FX. It's going to be about technical analysis, and today we're going to be discussing how to draw your analysis in a very basic setting. So trend lines, resistances, and this and that. Now, before we get to the actual meat of the webinar, as per regulation, the risk disclaimer, please feel free to read through that. Now everybody's speed reading. Okay, so what are we going to discuss today? Well, first of all, obviously I'll introduce myself. For those that have joined me in other webinars will know this, but for the new ones, I'll introduce myself. Then we're going to discuss how to draw your technicals. So a little bit of the rules, how you actually draw them, and how to read those out is obviously the second part, which is understanding your analysis. We're going to jump in a chart. We're going to do the drawing live together. We're going to read out the analysis so you understand what you actually drew, how you read them, what factors you take in. Then we're going to step into executing the trade, right? So now you've done your technicals, and now during the trade, how do you use those technical analysis in order to determine your trading micromanagement from a technical analysis point of view? And then obviously at the end there's a Q&A. There will be a brief pause before that to round off the recording for the YouTube people, and then we will jump into the Q&A in the live session. So yeah, who am I? Well, my name is Mike Rotting. Like I said, I'm 36, married, I have a daughter of 6. I live in Athens in Greece. I'm originally from the Netherlands, where I studied international business studies through a Cambridge program. This was also the period where I first got in touch with trading. Obviously, I was 19 at the time. My first account, had a few $100s to my name. I decided to do some self-trading, and like everybody else, followed every YouTube and, guru, self-proclaimed guru, and obviously screwed all that money up. I did that 2 or 3 times in a row. Always doing the same thing, expecting a different result. That will probably sound familiar for some people. Yeah, and then basically on the 4th one was basically where I eventually saw the light and started consistently making profit on a yearly basis, growing the account, started the whole session of evolving myself and becoming full-time in retail trading, doing it more than I should. Tried to do it for a living for 2 years, which probably aged me by 20. But it was a success in the end. Which brings me to what do I do? Obviously, during my time, I was involved with various brokerages, working for them. I did analysis. I obviously helped customer support, like account management. I have since then transitioned into what I am now studying for, basically, is wealth management, financial services, basically. And obviously I do a lot with VC, PE, and multi-asset investments, offshore investments, things like this. Obviously that's more something that I'm in touch with, and that's what I'm more involved with. And obviously I do mentoring and these webinars for myself, and hopefully for all of you. Now, drawing your technicals. Right, so when we talk about drawing our technicals, before we actually start drawing the technicals, let's understand what one of the basic rules is. And that's something called a top-down analysis. Now, who of you knows what I mean by top-down analysis? Feel free, guys, it's interactive, so I'm gonna throw curveballs at you. I want you guys to be involved. Otherwise, it's like watching paint dry. Okay. Yep, that is correct. Yes, okay. Luckily, everybody got that one. Yeah, so, right, it's very important to start at the highest time frame you're trading with down to the lowest time frame you're trading with. Now, when you are a trader that trades on, I hope not, but a minute or 5 minutes, don't start at a week. because if you overlay all the lines from weekday, 4 hour, 15, 30 minutes, 15 minutes into 5 minutes, you have so many lines on your screen, and it will look like a Picasso painting, but not a trading chart, because you won't know what the hell you're looking at anymore. General rule of thumb, I always say have 3 different time frames active. If you need to skip 1 or 2, it's okay. Right? Don't skip from a week to an hour, but you can skip day in that case and do 4 hours, and then instead of 1 hour, you do 30 minutes, for instance. I would still recommend staying above the minute mark. Personally, that's how I illustrate it, but obviously if it works for you below that, have at it. The rules will be the same. Obviously, volatility in lower time frames is much higher because they don't really have a direction at that point. So what are the rules of drawing? So one of the rules of drawing, apart from doing a top-down analysis, is that there's a reason why a lot of times I see people come to me and they have their trend lines, and I just look at the trend lines and go like, what do you draw? In a lot of cases, people try to fix the trend line to fix what they think they want to do. So instead of drawing a line to have the chart tell you what's going on, you already made up your mind, because usually you guys already have indicators on your charts. And you open your chart, let's say you're a US dollar, and you see your MACD is high and your RSI is high and your triple moving average is high. Oh yes, it means it's a sell. And then you start drawing, but you start drawing to fit the sell criteria. You're trying to make the chart tell you what you want it to tell you instead of telling you what it actually is doing. Right? So naked chart trading is a good way to start, especially as a beginner, to just do your analysis on a blank chart. Have nothing on it. No indicators, no grid lines, nothing. Just start blank, because that way you can't be influenced, and just let the trades, the lines tell you what to do. Now, a few rules. Trend lines do not cross charts, right? So for instance, if you have a high and you're drawing the top of the trend, it doesn't go cut candles. You don't cut through candles. If you do that, you're taking in breaks. So they should be fitting on top, and there's a way to do that very easy. I'll show you that in a minute. Obviously, resistance and support, obviously they're horizontal, so they are going to cross the chart. But in both line cases, one rule of thumb is what you prefer to see, and I say prefer because you're not always going to get that, is 3 solid connection points, which is body of candle, not wicks. Wicks is static, it's noise. It's basically a moment that it did something, but it didn't stay there. Confirmed price points is more important. So you want at least 3 connection points. Solid connection point in the recent history. Please, when sometimes you don't have too many connection points in the recent history because you're in an all-time high, right? Something like that. But please don't backtrack to freaking 2085. 1985 or something like that. I've seen people really go back 50 years. It's like, yeah, look, it was an all-time low here. Yeah, but the market 50 years ago has nothing to do with the market today. So it's completely irrelevant what you're comparing to each other. Most cases you can't go that far back, but you get the point. In general rule of thumb, stay within, like, let's say the month. Obviously, if you're at the start of a month, it doesn't work, but go back like 2-3 weeks is more than enough. If you're doing a week chart, you go back a year, maybe 2 years. But don't go back to 2008, especially since last year, 2020 COVID. Right? You can take some consideration of 2019, but it's already shifted. Right? If you would compare the markets to each other, think about it this way. And this is I use this analysis analogy on when I talk about indicators as well. If you would have a glacier, right, and this glacier has been growing a steady 1 centimeter per year over the last 300 years, then if you would put an analysis on that, you're going to get very reliable data. Now 2020 comes along, and which is a meteor in this case that hits that block of ice and melts everything. Your indicator or your technical analysis that compares to that previous point considers that a glacier that's been stable for 300 years. You, however, know that it's no longer a glacier. It's a flipping crater with a lake in it now. So those two markets have nothing to do with each other anymore. Over time, it may revert back to that old state because, obviously geolocation is not going to change that. But there is going to be a time lapse where that market has nothing to do with the past market. And this is something you have to keep in mind with technical analysis. This is something you have to keep in mind, especially with indicators and things like that, because they calculate based on historical data. So if something fundamentally shifts, the historical data is now void because it doesn't jive anymore with a new market. It's going to need time to reassess. So when you're drawing your technicals, keep in mind big drops and big shifts in the market because of certain things, like a pandemic, right? In March, we had a very sharp drop last year and then rally, but that still shifted the market by a few points. So you have to factor that in, that if you pull your line past that point, you're going to get a distorted picture. And I hope that makes sense for you people. So when we talk about drawing your trend lines, what's the easiest way to do this? Well, let's just go to a chart and just do it. So first of all, I don't need you. Now this is the Legacy FX's MT5 platform. One of the things that I do advise everybody is please don't use web-based charts, and the reason for that is because they don't memorize your history of your technical traders. I know there's a few sites out there that allow you to do a bunch of funky stuff, and it's fine. But in general, you want to trade with a platform the broker that you're trading your money with is providing, because then you get the accurate data based on their platform, right? Then furthermore, please don't do this on your phone or your tablet. I don't care how big your tablet is, it's not big enough. Right? You want a proper desktop with a proper screen to do your technical analysis so you have a good, solid overview on what you're looking at. You don't need to invest in multiple screens and have like 16 different charts and follow the news. That you don't need at home. We're retail traders, we're not working at Goldman Sachs. But it is important that more information is valuable. So if you have it, do it. But you don't have to invest into it directly. You can use Alt-Tab, right? But have a good screen so you can do the drawing properly. Now, as you see, I set up the Euro US dollar here, and this is on a week one, right? So the weekly chart. And why do we start at the weekly chart? And I usually start at the weekly chart. Month is not that relevant because then you get this picture. In this case, you will have, the long-lasting trend line where in this particular case, we know that if you follow this line, that it probably broke that line, but it's basically been moving horizontal for a while, and we know that, right, since 2015. And this is all the markets pre-2008. Like, see, 2008, the drop, like this market has nothing to do with this market. This is all the crisis. So, this is new market. So keep it focused to this. So we go to a week, which is more than enough data that we need. It's about 3 years back. That's plenty of data that we need to get a good idea of historical price points. If we do happen to be higher than this previous price point, then you can, zoom out a little bit and go like, okay, what was the previous point before that? Okay, that was over here, right? But that means that our current market would be over here because that's the only time that this becomes relevant as a reference point. Not as a fact, it's just, it helps you as a reference point, like, okay, at least you have something. So let's actually draw something. So like I said, we started a week. Now, one of the big problems we have is when we start to draw is, where do we start? Well, first let's look at the chart, what we're actually seeing. We see a high that went to a low, so that was a downtrend. Obviously, correction from spike, and then a continuation in a steady flow, that's the trend. This is the setup, right? So round off, correction into the stable trend. volatility March 2020, right? Nobody knew what was going to happen, so all the markets were up, down, left, right, and center. That has stabilized. We then had a little bit of a rally. Right, so we had our rally. Why do I say had? Well, everybody usually trades with this chart. The problem with this chart is that it gets actually cluttered because you see all these little spikes, wicks, and it becomes hard to see clear lines. So what I usually advise is just switch to a line chart, because basically what a line chart does, it shows you everything the same apart from the fact of the static noise. It takes the wicks out of the picture. And now the line becomes a lot clearer to draw on. So now the next part is where do you actually start? Well, for the longest time, we've been in an uptrend, as we can clearly see that from the previous low from 2020. We had a little bit of a consolidation phase, right? It was here horizontal. If we go back to the candlesticks for a moment, right? So volatility up, volatility down, up, down, and basically just corrected itself at the price it was. And it kind of moved sideways, and then it started moving. So this is not the point where you start, even though it is the lowest point, which is where you usually start. This was a correction of the volatility, and you then had a consolidation phase for a few weeks before it actually decided which direction to go. So we want to start at the bottom here. But if we go to a line chart and we take this point, don't do this, because that's not what the trend was doing. That's what the trend is now after a correction. This was your chart. This was your line. And here we see we have 1, 2 connection points. It's not 3, but if we now switch back to candlesticks, we're most likely going to see we do have 3 points. We do have a stop right here with a wick where it pulled back for a week, tried to go through it week 2, and then week 3 it broke through. So let's go back to the candlestick. So we now know that this uptrend has broken, right? Clearly, the line's gone through it. So what I see a lot of people do is like, oh, but I can do this, right? Well, yeah, I can do this because it's 1 and 2 points, but we just decided that this volatility correction is not the starting point. This is. So now you have 1 point. And now what you're doing is, this is the point that I was saying, is your mind sees up, so I want to buy. So I am looking to get the trends to show me a buying opportunity. Don't fall into that trap, because you're ignoring the entire actual trend that happened just to fit your mindset. So in an uptrend, you start at the bottom. So we now decided that, okay, so this got broken. That means that we actually don't start at the top. We start at the top because this is the previous high. Did we have a consolidation phase here where it moved sideways for a while? The answer is no. It did here, then continued, but here it just corrected straight back down. So going back to the line chart, we now just put our point right there. And now hopefully it works with me. Yes, it does. Right, so now you got to fiddle with it a little bit. There, okay, so this was the trend after that. So we had a little bit of correction here. So this is the best point we can find after that. So it did this, so it broke that downtrend as well. And as you can see in the week, I'm going through it step by step to see what did it do. So it broke that little correction downtrend and is now back up. So we're actually back to the bottom, drawing a line up. And now we get to a conundrum. It's through that line. So what could it mean if it broke both the down and the up? Even though it was an all-time high, or not an all-time high, it was a recent high, it then corrected itself back down. That could have just been a market correction. So if we would take that point and put this, can I do this? Who wants to take this one? Who says yes and who says no? So this one's a bit tricky. It's a yes and a no. Because of the touches, you can. However, there's one person that got it right. Good job. It's showing signs of consolidation. It's making a new platform, right? It's going to start moving sideways is basically what it's telling us. It doesn't want to go down. It doesn't want to go up. It kind of wants to stay in a certain range, apparently. So how do we get that to show a little bit better? So if I do this, and then also take the consolidation phase previously with the new high, and I do that, it shows us that this is basically what it's trying to do. So we don't have a definitive trend at the moment on a weekly basis. We have a converging situation where after this small consolidation phase, it spiked to a higher high, then corrected itself back down almost to the same price as it was, because that's apparently where it wants to be, then corrected itself back almost to the nearest high, and it's looking like it's bouncing back down. So what it looks like is that it wants to go down, up, down, up, down, up, and just bounce around that price point. Well, look at that. If you look at the price, it's 1.20111. Now, if I would just change that really fast to 120, it's that smack in the center. Which brings us to support and resistances. When we do support and resistance, so we don't have a trend line really, right? So in this case, we can't really draw a trend line. What we can do is have this as a reference line, that this is the current highs following, and this is the current lows following. It is a reference only. Don't trade on that line, right? It could be that in a day we're going to get a different view, but we're not at a day yet. Right, so we'll zoom in a little bit because we want a little bit closer view. Now, what I generally do is, in this scenario, I'm going to go do the trend lines first. So we're going to go to a day now. And you see that I don't see my weekly lines anymore. Anybody know why? You can turn off in what week and what chart you can see and can't see lines. Specific lines. In this case, I want to see them. So I go to the visualization of the line. I want to see them up to hours. And now they will show up again. Now here's one funny thing. We see that it fits the daily on the bottom. It does not fit the daily on the top. And that makes sense because on a day, it's more volatile than a week. An hour is more volatile than a day. A minute is more volatile than you should trade on. But that's beside the point. I'm not saying you can't trade on a minute. I know there's people that trade on a minute, don't be offended. But a minute doesn't really have a direction. It has a direction for a very short period of time, then goes a different direction. So drawing technicals on minutes is, well, you have to be fast. Now, one thing that you want to do is obviously if you start drawing these lines, so if I put in my daily chart now and my daily lines, I can very clearly see why 1-2 connection point Y broke. It just went straight through here. Now I don't really have anything on the top because I can't really, I have nothing to draw from. I have a bottom line that I can maybe use. Is that still valid? Yes. So on a daily chart, the uptrend holds. We know on a weekly it's through. Currently, it's Thursday, which means that if this tomorrow corrects itself back up, what's going to happen is that it's going to fit the week again, because this will pull in this chart, right? This weekly will pull back in, and then it will stay closed above this line. So this is for your decision making later on. So let's go back to a day. But the problem is, if I keep all these lines the same color, I'm going to run into a big issue, because I don't know what the hell I'm looking at anymore at that point. So here, currently we're through it with a day. So I have at the moment nothing to really draw here. But for argument's sake, we're going to draw it like this. I know this is wrong, but just bear with me here. The most important thing you want to do is color code your lines based on what? Chart day or time frame. So in my case, maroon is week lines. Blue is going to be the daily lines, and green or whatever color you want is going to be my, let's say, 1 hour line. Right? Because it's already through this line, although it's not confirmed yet that it's through this line, it's not a line I can draw because I'm crossing through the chart. And what do trend lines not do is cross through charts. They always stay under or above it. You can't cut through them. So on a daily chart, we don't have a trend line. And that is consistent with it trying to find a consolidation point. And please don't tell me like, okay, but I can do this. We discussed that. And doing this is like, yeah, but you already have that one. It's the same on a week. And a week is a higher time frame, thus it overrules your day. Right? Don't start drawing all the lines at the same time and in the same spots, because the higher time frame rules. So if there's already or very close to it a trend line from another time frame, leave it. So now fast forward. So we go to a day where we said, okay, we have this, where it's literally just not touching it on a daily basis. It will probably if we switch to this. Nah, just a little bit. So here you can correct it a little bit. You had, right, because we don't want it to chart, we can fix it here a little bit. So now it's literally at that point where it's trying to push through, but it doesn't want to know. And this is because there's not enough sellers to push it down, but there's not enough buyers to push it up either. That makes sense, right? Volume is what makes the market move. But for argument's sake, we're going to keep this line for now as a reference. If it goes through this, we can probably expect it to go down, but there's more than trend lines to consider, right? So let's go to an hourly chart. And we do the same thing here. We just go to a line chart. And I can see my week trend here. That's obviously very far away from the hourly chart. We can see our day chart here, but this is telling us a very big deal. It's basically just moving sideways all day, right? This is since this morning. Is there a trend here? No. This is not a trend. That's not a trend, right? That and that is not trends. So we have nothing. Now, an argument can be made for this. But where's the bottom side? Because a trend moves in a channel. So let's use an equidistant one and let's draw it. Well, that doesn't fit at all because I can't go beyond this line. I can't go behind it. I can't fix a line behind the starting point. So it would have to be in front of it. So this was the previous low. Well, that doesn't fit. So now I'm here. That's the, oh, well, that doesn't make any sense at all. Right? I'm literally just shooting into the floor for no reason. So this is not a line. Which brings us to support and resistance, because those we do have. So we go back to a week. Now, we're going to use maroon for weeks. We're going to use blue for days, and we're going to use, I don't know yet, for an hour. Or you can use 4 hour, whichever you prefer. It doesn't matter. So first things first, you start at the low and the high, identifying the low and the high. Well, that could be this and this, which technically speaking isn't wrong. But does it give you any valuable information to your current market? No, exactly. Of course not. It's like this is literally weeks away. It's like it's great to know that that's a low point, but you know it's pointless. This is the most recent markets kind of low that you can keep in mind. That's still quite a decent way away from current market price. As for the high, well, yeah, you have this one only. So yeah, you can take this one and leave it. What did we say? What color are we doing? Maroon, right? Need to find it. Maroon, yes. I hope the colors are visible for everybody, by the way. I think it should be. Whoops. Obviously, if people are colorblind, I'm sorry. You know, I'm gonna have to find a color scheme that you can differentiate from each other. Different grayscales, for instance. Okay, so we identified the easy ones. We have one high reference in case this decides to spike up. So we know where the previous high is. But this is the current market high. This is the current market low that we are in very recent, you know, we're going back to 2020. This is a week chart. Keep that in mind, right? So this is a good few months back. So that's big enough of a range. We also see now that this connection point where it wants to get together, whoops, where we want to get together is dead smack in the center almost. Which makes sense because we already established it's showing signs of consolidation, right? So let me make it a bit bigger again. But this is not all we can draw. So on a week, you don't want to make 50 lines. The lower the time frame, the more detailed you go because there's more micromanagement you can do. When you trade on a week chart, you don't need to do a micromanagement every day. It's a week trade. You let it run. You don't care if it turns left one day and right the other. Right? You only care about point A and point B over the course of a week, and it's going to go up and down in that period. Let's see if there's any solid connection in between. So let's grab a line. Let's see, we have one reference here. That's a reference. Nah. Oh, well, we have this previous, you know, little peak here that goes there. I mean, that's fine. It's far enough away from our current market. It doesn't clutter it too much. We're okay with that. So that would be fine. You have 1, 2, 3 connection points, 2 ups and 1 down. Let me zoom in a little bit. Sorry, I need to keep it. So 1, 2, 3. It doesn't have to be a solid connection, guys, because once you switch back to this chart, now it connects, right? Now the wicks come back in, the static, the noise, and now all of a sudden the lines connect. Now you prefer solid bodies. We have one here and one here. After this day, it opened right here, a little bit after a gap, which was a Monday probably, and it corrected back in first, but then decided to go down. Right? Learn how to read what charts did in the past. Understand how candles develop. This is very, very useful to understand if your line makes sense, yes or no. We don't have time to get into it now. Okay, so we're pretty much done with the week. I know enough about a week. I know that this is going to be a resistance for it to go further up. This is going to be a support to push it back up and stop it from going down, right? Difference between support and resistance, I'll let you guys figure it out. It's the support and resistance line are the same line. It just depends on which way the market is going and the trend is going depending on that line. If the trend is up, a line above it is a resistance because it stops it from going further. If the line is below it, it stops it from falling, which means it's a support. Makes sense, right? And then if you're in a downtrend, you flip it around. Now, a lot of you might notice that it seems to be very odd that they get very close to very even numbers. And I'll get back to that in a minute. But let's do the day first. Let's get through these charts. So what do we do? Blue. So let me just draw a quick line. And we want that one blue, dark blue. Yeah, that's fine. That's hopefully visible for everybody. All right, so let's do this on a day. We want the recent history, which is the past, you know, month or 2, 3, right? On a day, month or 2, 3. On a week, 2 or 3 years. Is there a pattern? Anybody recognize a pattern? I'm sure they do. So this is what we discussed earlier. I can put my high on this, but why would I not draw that? And why do you think you should? Who wants to take this one? Draw it or don't draw it, and why? One says draw it, the other says no. So in this case, when you get close to this line, you don't look at this blue one, so you don't draw it. Because when you get here, you switch to a week chart, because now it becomes important if it closes under this line under a week. I don't care what it does in a day. I care if it closes underneath it in a week. If it closes underneath it in the week, let's say it is Thursday, and we are here, I don't care what it does today. I care what it does tomorrow. If tomorrow closes under this line, we're going to go back down. If it closes above this line, the probability of it going up is higher. And we retail traders don't make the market move. We don't have nearly enough cash for that, right? So what we do? We ride the wave. We just follow whatever the market does. You're not going to influence it. Just go along with the flow. But you can find out what the flow is before it happens. Keep in mind that usually these lines are, they seemingly are like this one is at 122,480. Well, 122,500 is a very nice even number. Where do people tend to put buy and sell orders? At even numbers. It's a human thing. People have a tendency to not put a sell limit in like this. They put in a sell limit at, 123. Well, they make it 123,500. That's what people do. So you need to understand when you get to high highs, there's a lot of pending sell orders. So the moment that the market gets there, a lot of take profits are hit and a lot of sell orders are hit at the same time, which means the market volume flips. This is why you see that happen. The question now is there more push market in faith of a price that belongs higher or lower if you're going down? In that case, it continues. But usually you will have stalling moments along the way, which is basically your weekly resistances. And in our case is obviously the monthly one. But not many trade on a month, in retail at least. Monthly becomes more relevant at the end of quarters, Q1, 2, 3, 4, depending on where it is. But for retail trading, you don't have to worry about that. So we trade on a week. If we're close to this line, I don't care about what it does on a day. I only care about what it does in a week. Because for instance here, it closed outside on a day. Now, if you would then religiously say, well, I closed outside of my weekly line, so I'm going to go take a buy, then you would have gone screwed over because it corrected itself back into it after the end of the week, by the end of the week, and does close underneath it and actually went down, not up. So the one that we can draw is underneath that line. And the first time we can't, what I usually do is just literally like this, like a scanner. And I just eye along my line. So here we have one connection point. Do we have anything else? 1, 2? Nah, not really. And it's very close to that weekly line. It's not that great. Let's keep going. Okay, maybe one here, one. We're still very, very close to that weak line, right? But this could be something. Let's keep going. No, well, 1, 2, present market, but you have this, but that's probably hour or something like that. Oh wait, hold on. And 1, 2, a little bit of the middle, kind of where the market is right now. So if I move a little bit more down, let's play with it a little bit more to the recent market. Now we go to low, I think. Well, hey, that's actually in between the two. It's literally dead smack in the center. The market shifted a little bit. Oh yeah, that makes sense. It was going down here, it's going up here. So obviously there's a slight variation. Down into correction, into showing signs of a converging channel, ergo it wants to start to consolidate, which makes sense that it, wait, hold on, this is also very close to where the lines are. So if we take the second line and we follow that further, no, we're now at the weak line, so we don't care about that point. And here again, we see that if we go to the center, 1, 2, 3, 4, 5, 6. This is obviously the bounce off of that, or at least sort of. There's also this line that it was following. I'll draw it real fast so you can see it. Right, there was that line. I'm following this point, not that point. Right, if I put on the things, it's probably wicks. Yeah, see, wick, wick, wick. Oops. There we go. So these are more my daily charts. So here you can fine tune it a bit if you want. Like, okay, this was more clearly the day. Like the line takes the noise out. Now you fine tune a little bit. And here we can see this is actually fine. 1, 2, 3. So this one shifted a little bit. This week is very close to it. That's okay. But we know that this was the previous low, so we can use it. It has some correlation with the consolidation here and some correlation here. So we have the 1, 2, 3 points, right? So that's close enough. Keep in mind again, it is indicative. It's not written in stone. It's roughly around that point is where it can bounce off. So when you start getting close to these lines is when you start making micro decisions. So now when we go to an hourly chart, right, you can see that I need to go really far in order to see those lines. But it's good enough. I can see the past few days. Now we decided is a trend. Okay, so on the hourly, we have the previous high. We go back to this chart. 1, 2, 3, that's fine. Now we have to decide our color. Okay, let's see, what color do we want? Let's do something that doesn't interfere when we open a trade. Grayscale, nah, it's too subtle. Let's go with gold. Nah, looks too much like brown, right? Let's see, we have red, blue, and, well, I guess green then. There we go. So green is like an hour. So here we go. We have that. Do we have a bottom reference? No, because it's basically the same as the day one. So this is just for the top that we know on a trends point of view. Now we do the resistances. This one? Yes, no? Well, it's in between the, well, that's funny. Anybody notice any pattern? Did I do green or teal? I don't remember. Oh, green is better. Oh, this is green. Why does this look darker than this one? No, it doesn't matter. Right, so this is very, very solid previous high, right, on an hourly chart. And then, funny enough, we see again, week, hour, day. It's again now in the middle of the two. Now, we obviously are not going to draw this one because that's dead smack on the day. So I want to know there. We're closer to a day ending now, so we want to know how it ends on a day basis. But if we look a little bit further, and I'm eyeballing my line all the way across, and I can zoom out a little bit to get a little bit more overview. I have this little thing in the way. Okay, so if I do this, we have this part, we have this part. But if I take it roughly over here, we have a solid point here where you really have a moment where it took 1, 2, 3, 4 tries to get through, and it didn't do it till the 5th after a correction. And then here, it literally just bounced right off of it. Slapped into it, bounced off of it, and consolidation with. And again, blue, green, red. Here it was red, green, blue. and they're in the middle. That makes sense. The smaller time frames are going to be in between the higher time frames. This is why you do top down. We have our 3 connection points. We now have reference points. We now know that if I'm looking at a day chart and it's through this part, I go to my hourly chart, and now in my hourly chart, I know, okay, we're close to this. When I'm looking at my hourly chart and we're at this and it starts stalling and starts bouncing like this, now I start looking at when it starts touching this. If it closes outside of this line in an hourly chart, which I can now extrapolate like this, if it comes here, it breaks through, let's say, it goes through this line, so through the daily trend. We don't care about the daily trend. Weekly trend is down here. Breaks through, bounces off of this, goes like this, bounces here. Now we know exactly what to do when what happens. Scenario 1, it closes outside of this, which means we're going to go back to probably the daily line. If it goes down, we're probably going to go to the weekly resistance. Now you know your price, buy, sell. Right now, you are kind of in limbo. If it closes above this line tonight on a candlestick chart, bloop, make it bigger. All right, we're at the day. So what's important to now for us to know tonight is if this candle retracts at the end of the day and closes above it. Now we know that it's done it before where it closed just slightly under it and then pulled back. So here we can fine tune the line a little bit if we want to more correspond with the previous most recent market low, which still has those connection points. This is where you fine tune it a little bit. This is the line that it hasn't closed underneath. If it does, and it closes underneath this, most likely it will drop. But if it closes like on this line or slightly in between these two, there's a good chance that tomorrow it's going to like hang around and then eventually bounce back up. But we need to wait for that. Right now, you're in a sticky situation because you don't have a direction. We don't have a trend. So if you would done this analysis, and obviously when you get experience, you do this a lot faster than we did now in 30 minutes. You do this in 5 minutes probably, the whole thing. But you will understand after just drawing the weekly lines, there's no trend. You have a consolidation. It's probably a converging channel. So it's looking at the consolidation phase. Is consolidation phase a good money maker for us? No. So next chart. Right. The reason I wanted to show you that is that it's still important to do the analysis instead of just mug it off like, oh, it looks like a buy, or it looks like you don't know until you've done all the analysis, especially when you're new. Yes, when you're a little bit more experienced, you can eyeball some things, but in general, you still do the analysis. What is important when you go back to a week now, what you can do, this is MT5, yes. As you can see here, now it's a little bit messy. There's a lot of stuff. Now imagine if I also put my moving averages on top of this and Fibonacci or whatever indicators you guys use. It just becomes a giant cluster and I can't see the chart anymore. So how do we fix that? For all your daily lines, the one thing you do is I don't want to see my daily lines in daily, weekly, or monthly. Or my hourly lines. I don't want to see my day lines in month or in week or month. Why don't I want to see them in the day, in the week, or the month? So now it's clean. Now I only have the relevant information to me on a week chart. Exactly. Thank you, Tanaka. That's exactly it. They're not relevant. I don't care about the day resistance on a week chart. But when I go to a day, boom, there they are again. I just don't want to see the green stuff. For some reason, that shouldn't be here. It should be there. They're done. Now I just see day and week. If I go to an hour, I see all of my lines. If I go back to a week, it's clear. So when I work with indicators and all the other stuff, I can still see my chart. You know how many times people will send me their analysis and all I see is lines and indicators and Fibonacci retracement and Bollinger Bands and 6 moving averages. Everything is color coded like they're making an LGBTQ plus flag. Like, what are you trying to figure out at this point? Are you trying to figure out a trade or your sexual orientation? Because I don't know anymore. Keep it to the point. What are you trying to do? What you're trying to do is trying to get the best possible indication of what the charts have been doing and how are they going to move. Which brings us to, well, understanding your analysis. So what did you just do? Well, with the trend lines, yes, Tanaka, you can. So what did you just do? With your trend lines, what you do is you determine the movement or the suggested movement that it currently has momentum in based on different time frames. And if you get a correlation where the week, day, and 4 hourly, and everything else lines up and they're all doing the same thing, you have a very stable trend. So don't trade against it. Because remember, a trend will only change if there is a fundamental reason for it to do so. It's not going to change because of a line on a chart. There can be a change because of certain price points, and that's usually the big ones, right? So if the range for the euro is between 120 and 130, obviously the big numbers are whole numbers, right? 121, 122, 123, 124, right? A cent increase, which is obviously a big deal, right? So, you know, that's where it could trade, because you need to keep in mind, like I said, where do traders, and you need to think strategically, think about it like chess. If I was another trader and I had a buy in this position, would I be closing it now? And if I wouldn't, where would my take profit be instead? And humans are creatures of habit, and we like even numbers. Think to yourself, do you prefer having a stop loss and a take profit at even numbers or at 1.12133? It's in our head. People do that. You shouldn't care about these uneven numbers, but oh God, OCD. It's 119.1899. Okay, I'll make it 119,200. Right? Majority of people think like that. Majority of people, if it's 112,400, they'll make it 112,500. So keep that in mind. And when it comes to pending orders, they're usually, the vast majority are set to even numbers, because you have to pre-type them, and typing even numbers is easier. So keep that in mind, plan that ahead. Your support and your resistance are basically your indicators for this is where the market could stall or stop. And again, this depends on if you're at a big turning point like half or whole numbers. This has to do with obviously the momentum, but think about what makes a market change is if the volume turns around. So if you're having a buy and you start getting to a new high and it's an even number, you're going to notice quite often that that's where it's going to start stalling, because that's where a lot of sell orders are, and that's where a lot of people have their take profits of their buys. So the volume for buy decreases and the sell starts to increase. An asset picks up momentum, that's when most traders who like to wait for price action confirmation then start trading. So now you're starting to accelerate it. Right, and then once the trade is developed, obviously that's when people start, you know, getting more confident to actually trade into it. So your support and your resistance is your decision-making moments, especially, in a week, for instance. Let's say you're on a Friday. Let's say you have a trade open and you're, let's say, 60 pips in profit. No, let's do it the other way. Let's say you're 15 pips in loss. You're just above the weekly resistance. You're nowhere near your stop loss yet, but it looks like it might actually start close above that resistance. Well, what you can do is you do yourself a favor and take the loss. Micromanagement. It's okay to take a loss. It's losing is part of trading. But it's controlling the downside. That's the important part. You don't control how much you win. I've never heard anybody complain about more money. I've heard them complain about losing money, though. So control that side, the rest will come. So that obviously answers already the next one. How does this help you trade? Well, that's how it helps you trade, right? It helps you to make decision on whether you should keep the trade open or close it. And it also helps you with your entry and exit strategy, which is what we're going to discuss in the next upcoming webinar, how to do those things. So how do you set yourself up for the trade? There's a few points to it. So now you have done your analysis. If you use indicators, you now put those on top and see where the indicators are at as a confirmation to what you think you see. If you think that you saw sell and your technical analysis is telling you it's a sell, and then your indicators go on it and they tell you it's a buy, well, then I don't know what your strategy is, but by rule of thing, it would basically tell you, okay, maybe you shouldn't take the sell. If it tells you again a sell, then there's a pretty good chance sell is what it's going to do. So you're setting yourself up to take only the most highest probability trades of what it's going to do. There is no security. There's no 100% guarantee. All we're trying to do is figure out what is the biggest probability of what it will do when, and just take that chance. If there is a 70% chance for a sell and a 30% chance for a buy, there's no reason to take the buy. You go with the 70%, because if you consistently do that, you'll be winning 70% of the time. Yet for some odd reason, the majority of retail traders do the 30% thing because they think they're smarter than the market, and they end up doing the opposite, which I'm more than happy to take their money, but that's not the point. Follow the trend. Just do what it tells you to do. So when we get to trading, there's often this little point where, and more of tips from me, psychology. So what I noticed when I was doing, like I said, my first accounts, and you had all these trading gurus and all these things that I follow in the YouTube videos and all that, everybody was hammering about psychology, and your psychology needs to be right, and this and that, and it's your mindset that gets you through the day. And God, what a load of bollocks. When you have a solid trading strategy that is back testable and that is historically correct, the markets don't shift that much, even if they shift back to the glacier versus, crater and lake, reverting eventually back to a glacier, obviously, over time. But there might be a dimple where the market changes, but in general, the behavior of the market in itself generally doesn't tend to change that much. You either have a bullish market or a bearish market, and certain pairs behave in certain ways, almost always, historically speaking, in those markets. So identify and understand how that works. That has nothing to do with psychology, because if your strategy works and you backtest it and it fixes and it works on that, then you are statistically setting yourself up to trade with a proper strategy. And if you trade with a proper strategy, psychology is not a factor. Yes, you're going to have emotional days. You're going to be, influenced. You could have a bad day when you woke up. You got up out of bed, you stubbed your toe on the pole. Shit. Okay, you walked into the living room. The dog had a pee on the carpet. Great start of the day, and then you start trading. Yeah, you're gonna make different decisions than when you wake up and you find out you're in the middle of the Bahamas. Right? Your mindset is going to be different, but that has nothing to do with what the market does. It doesn't care what your day is like. The market does what the market does. The big money trades very specifically and very strategized. So there's no reason. If you are having a bad day and you're really in just a shit mindset and a bad mood and you're very negative, just don't trade. The market's still going to be there tomorrow. And if it's not, you have bigger issues to worry about. Right? So psychology is only like a buzzword that a lot of people use in retail trading. What is actually just a buzzword. If you're trading with a proper strategy, psychology is not really a factor. Because you just need to learn to trust your strategy, period. And part of your strategy is risk management. One of the webinars that I did 2 or 3 weeks ago, risk management is probably the key essential kernel point of how to control and your wins and losses. And if you do this with a proper setup, it doesn't matter. If you, and I in that webinar, I discussed and I showed how with a 40% win rate, you have a profitable account. 40% win rate, which literally means that if you do a coin flip and just click the button on sell and buy based on the coin flip, you do worse than that, statistically speaking. Knowing when to cut your losses, knowing how to control your losses, knowing how to set up your risk percentage-wise to your capital, how to utilize your capital, how to diversify, how to set up your exposure. This is very key. And this comes in conjunction with your technicals, right? Because your technicals say one thing and you use that to analyze everything else. You can also kind of determine the duration of your trade based on technicals, because like in the converging lines that we had right here, in this, where we have those converging lines, if we just take the current market price and I would take a sell and I go down, up, but I just pull it sideways, it tells me 41, 42, 43, 44 bars. It's going to be a little bit out of the screen, but here it says 36. So on average, this will take 36 weeks. So if I would be trading on an hour and I want to find out like, okay, how long is it going to take to go if it goes this angle on average from current market price to here, it's going to take 10 bars, which is about 10 hours. Now, obviously, it can do this now and just spike like this, which means it already hits your point here. But let's say it does, up, down, up, down, up, down, up, down, and just keeps going sideways until it bounces into this. Longest time it will take is 15 bars to get to this line, to get to this corner, right? So you can use that to plot out your timeline a little bit. Okay. So that's it for the source, the core of the webinar for the theory, and everybody that is going to be leaving us. Thank you for listening. I hope you enjoyed it. I hope you learned something. I hope it was valuable to you. I'd love to see you on another one.